Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. Now, we're past the US election, and there's rising focus on what a Trump administration in the US means for policy as well as financial markets in the US and elsewhere. How should investors interpret or act on incoming information about what a future US administration could look like? To discuss this and more, I'm joined today by Rajat Bhattacharya, who's Senior Investment Strategist in the CIO office. So thanks, Rajat, for joining us today. It looks like the Republicans have now won not only the White House, but both houses of Congress. In your view, what does this mean for US policy going forward, and what do you see as the key market implications?
Hi, Manpreet. Yes, that's right. In the last week, we got news that US Republicans have gained control of the House of Representatives, and they had already won the Senate earlier. So, which gives them the three centers of power in the US: the White House and the two houses of Congress. This also gives President elect Trump significant power to implement his often contentious agenda. For investors, his pro growth America First plan, which involves tax cuts and deregulation, intuitively implies stocks outperforming bonds and US assets and the dollar outperforming non US assets. However, most of the so called Trump trades have played out as expected. Also, early Trump cabinet appointments suggest a priority on the more contentious parts of his agenda, which is diffusing geopolitical conflicts, confronting China on trade using tariffs, deporting illegal immigrants, and cutting government costs. For investors, while easy gains are over, what this means is that we still see value in US financial and small cap sectors in the near term, and also see the rise in US government bond yields as an opportunity to lock in attractive income over the long term.
Okay, you'd made a mention of Trump's potential cabinet appointments. I wanted to dig a little deeper into that. From what we've seen in the news so far, what can we learn from Trump's cabinet appointments?
Yeah, Trump seems to have put a priority on easing geopolitical conflicts, and this is reflected in the markets. The sharp drop in gold and crude oil prices since Trump's election reflects a fall in the geopolitical risk premium as Trump seeks to end the conflicts as soon as he takes charge, if not sooner. If you remember, he said that he would want to end the Russia Ukraine conflict before day one or on day one. He has already made calls to Ukraine President Zelensky and also reportedly called Russia's Putin, although the Kremlin has denied that report. Easing geopolitical risks and lower energy costs are ultimately positive for risk assets. Now, while he tries to settle the Ukraine Russia conflict, we're likely to see Trump confronting China on trade issues. Trump's nomination of China hawks, such as Marco Rubio for the Secretary of State, Pete Hegseth for Defense Secretary, and Mike Waltz as a National Security Advisor, point to an intent to confront China head on. Although Trump has proposed to put 10% tariff on all imports and 60% tariff on imports from China, his economic advisors have said that any such tariffs are likely to be implemented in phases, using them as a negotiating tool with trade partners to coax overseas suppliers to shift their production to the US. Additionally, the tariffs are meant to partly pay for the tax cut proposals that he wants to propose later down the line, and are thus meant to reduce the budget deficit. While the tariffs are likely to be temporarily inflationary as importers pass on the cost to consumers, the Fed is likely to look through the short term impact. Above all, the tariffs are likely to protect domestic small businesses from imports. Then we have the priority on government efficiency and deregulation. The nomination of Tesla CEO Musk to head a new department of government efficiency suggests cutting government costs is a top priority. Musk has said that he is it's even possible to cut expenses by as much as $2 trillion, which is almost equal to 30% of last fiscal year's government spending. Now, while such savings look like a tall order, significant cost cuts would help the administration pay for its tax cutting plan later down probably next year without significantly raising the deficit. And finally, he is intent on the immigration curbs and including deportations in the near term. Of Trump's key policy proposals, immigration curbs have the biggest potential for stoking inflation expectations against the backdrop of a tight labor market. He has nominated immigration hardliners to key positions already. However, I must add that the administration's plan to deport undocumented migrants is likely to face severe logistical and legal constraints because deportations cost a lot of money to begin with, running into hundreds of billions of dollars probably. Uh, Trump is more likely to continue his program from his previous stint to keep migrants in Mexico until their applications are processed. Also, Trump avowedly believes in managing immigration through the official route, which should help partly mitigate wage inflation risks.
Okay, no, thanks for that comprehensive overview. Let's move to Trump trades in financial markets. I mean, we discussed many on this podcast as well in the weeks leading up to the election. Are these now overbought, or do you still see any opportunities for investors today?
Yeah, some of the Trump trades look overbought. For instance, the dollar looks overbought, and could see the near-term consolidation. The ones that stand out are U.S. financial and small cap equities, and they may have some more room to run up near term. The two sectors are likely to benefit from deregulation and tariff protection, respectively. Now, let me explain in a bit more detail. We measured the performance of Trump trades in equities from the time Trump started surging ahead in polls in mid-September to just this week, and compared the return of such trades from the time of his 2016 victory to a month after the election at that time. Now, we believe this offers a reasonable comparison given his 2016 win was a surprise. Now, based on this analysis, US financials and small caps appear to have more room to run, with returns of almost 12% and 8% in the current period versus 18% returns back in 2016. Now, we believe long term catalysts are positive for US caps in the first place, driven by Trump's pro growth policies. Potential tax cuts on both individuals and corporates are likely to support consumption and cyclical growth. His pledge to impose tariffs on imports would provide a more competitive environment for local businesses. Companies that are able to transfer rising raw material costs to consumers are also set to benefit from higher earnings growth. In addition, our expectations of falling Fed policy rates provide a further tailwind to small caps because they have the tendency to hold floating rate debt. Now, positioning, by that I mean investor positioning, is crowded, but valuations remain undemanding versus the S&P 500. The S&P 500, for instance, trades at 22 times forward earnings, whereas the small caps are trading at 17 times around. So this uh, and together with rising earnings growth is positive for the small cap sector. I must also add that convertible bonds can offer an alternative route to gaining exposure to this trade, as the size of the issuers are mostly small and mid cap companies. We retain our opportunistic buys on convertible bonds based on our expectation that they will benefit from further equity market gains and Fed rate cuts over the next 6 to 12 months.
All right. And very quickly, what about opportunities in the bond market?
Yeah, the benchmark 10-year government bond yield has risen since Trump's victory on concerns that his policies could be inflationary and could increase the budget deficit substantially. However, the yield remains almost 30 basis points below April's peak, indicating that such inflation concerns are still relatively contained. Technical charts suggest the 10-year yield is still hovering below the resistance level of around 4.5%. US consumer inflation in October this week met expectations. Now, although Fed Chair Powell said this week that he is not in a hurry to cut rates, markets remain optimistic that the Fed will remain on its rate cutting path next year, albeit a slower rate cutting path maybe, driving bond yields lower over a 6 to 12-month horizon. Hence, we view any yield spikes as opportunities to lock in attractive yields over the longer term. Nevertheless, we believe this trend is likely to manifest more clearly at the short end of the curve. While there is potential for the long end yields to decline too, the longer term inflation and growth outlook expectations present greater uncertainty because of Trump. On balance, this continues to suggest a mid maturity, so that by that I mean 5 to 7 years, offers the most attractive risk reward balance in bond allocations. I must add that investors will need to closely watch market based inflation expectations, which have been rising lately but still remain within long term ranges. A sustained rise in those expectations could lead to Fed pausing rates or even hiking, which could be detrimental to bonds as well as stocks.
All right. Well, thank you, Rajat. I think we'll bring today's conversation to an end there. Thanks for taking the time to join us today. If I can just summarize the key takeaways for investors. Number one, of course, in terms of Trump trades, we still see potential in US financials and small cap sectors in the US equity market. Second, of course, yields still offering a potential opportunity for income. And third, of course, convertible bonds can be an option where investors are looking for opportunistic ideas. Uh, Thank you, listeners, for joining us on today's conversation. We hope you found it interesting and insightful, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.